Hello, everyone. Alexander Kaminer here from Twin Shores, the Translator YouTube channel, where we help translate what is happening in the financial markets so people can use it in their day-to-day lives and make sharper financial decisions. I'm here with Tim Nihill, our CEO and Chief Financial Planner. And today we have this presentation that is about financial health in 2020. And we just want to share this with you. So Tim, let's start us off here. What's going on?
Yeah. First and foremost, I think it's 2022.
Oh,
It's all right. It's cool. We're done. We're done with the crux of or the depth of COVID. We're beyond that, I think. Anyways, to frame this presentation, so this is a presentation that we've been presenting at seminars per request with other professionals and just seminars we've been requested to do. We update it year over year, because it really covers the gambit of financial planning, and we theme it based on what we're seeing. But overall, I think the goal of this presentation is just to help people understand the dynamics of what's going on in today's financial world, the financial markets, the economy, and how it applies to their day-to-day financial health. So the goal of this is to just share information with people to get you thinking about, what's going on and what we're seeing coming at us, and what to do to prepare for it, because obviously 2022 is a different story. And from our perspective in the financial advisory world, we're seeing a massive amount of changes. And quite frankly, I was going back and forth with a friend of mine today who lives on the West Coast, and we're just talking about how the financial advisory world and how things have been done for the past 20 years is over. Asset allocation, dollar cost averaging, none of that stuff works anymore. Stocks, bonds, and cash, if you're going to ride it out through the next couple of years, I think a lot of people are going to have, and they're going to come to find there's going to be some severe gaps with what they're doing from a planning perspective. So, this is just about a half an hour presentation to talk about a lot of those things. So why don't we kind of take it from there? So just so you know who we are, under the Twin Shores umbrella, we have Twin Shores Wealth Management, LLC. This is our traditional financial planning and wealth management firm, investment management, insurance, long-term care, all that fun stuff. Beneath that is we also have Twin Shores Capital, which is our digital assets firm. So we are one of the first firms in the country to get into this space. We believe that as fiduciaries, our client's best interest comes first. And we just don't think that, not allocating a little percentage of your investments to this world is the right thing to do. So, what we're trying to do is just bridge the gap of traditional finance with what's coming into the new world and making sure that we put people in the best position to succeed. One of the things I always learned when I was a young investor, even going back to when I was, believe it or not, 6 or 7 years old, is investing in the future. And that's what we do. So what we're going to talk about today and really set the table for this presentation, we already kind of set the table. We'll just put the forks and knives and the glasses out with the nice silverware. We're going to talk about the themes. And I know this presentation we're rolling out in September, but I think we're going to see some substantial things that are going to happen in the next 3 months. So I think people should really start preparing now. We'll talk about the investment world we're looking at. We're going to talk about building your quote unquote portfolio. We'll talk about what we're seeing in the digital asset space, and then we'll, wrap it up from there.
good plan.
Good plan. Yeah. So setting the table. So what in the world is going on with investing today? Here's the theme of it. If you're in the United States, and this applies to China, Russia, India, European Union, especially, which is everyone's watching going bankrupt right now. Here's the crux of it. The United States never fixed the problems from 2008. The worst words that ever happened was too big to fail. Those big companies like Merrill Lynch and the likes of other ones, Bain Capital, et cetera, they should have all gone out of business. But they didn't. And what happened was the federal government came in and said, we're going to bail them out. So they printed money and injected capital into the system, right? Here's why this is very, very important. We are no longer a capitalist market. We are not a free market economy. They broke that in 2008 when the central planners and the Federal Reserve walked in and they took over and they made sure that these financial companies and banking institutions did not collapse. And quite frankly, you should let them collapse. They should have all gone out of business for not doing their jobs. And out of the ashes, new firms would have come out, right? New technology, new firms, new solutions, new investments. But we didn't do that. And this is why this is important. We went in the United States from a free market economy the second this happened to a central planned economy. That's not capitalism. So we've been, I would say, limping along since 2008. If you look at the actual growth numbers of the United States, on average, we've only been growing at about 2% per year since 2008. But our stock markets are up on average, what, 10, 12% year over year? This is the money. This is the reason why, is because the US government and the Federal Reserve Bank have been printing money and injecting capital into the system, essentially, which means they've been financing the system, right? So if you look at most of your stocks in the S&P 500 and the NASDAQ, which are, top 100 technology companies, their stock valuations are trading at 30 to 50 to 100 times earnings. Does that make sense?
Right.
Basically, the stock prices are overinflated. Why this is important is because you're not buying the true value of the stock today. You're buying an overinflated stock. That's tied to money supply. And if you look on this band right here in 2020, see this right here? It's like a straight arm up. So essentially, the central bank and the planners and the government injected 80% of all money created was created in the past 2 years and put into the system, right? So if you're a listener, what that means is if you had $1 at January 1st in 2020, and then they just injected 80% new dollars into the system, the true value of your dollar is not $1, it's actually 20 cents on the dollar now. Now do you see where inflation is the problem?
Yeah.
Make sense?
Yeah.
This is important. You have to pay attention to this. This is why people run around and are watching the Federal Reserve, is because everything is tied to this massive bubble that has been created in cash, in stocks, and in bonds. Interest rates. We talk about interest rates. Look at where they are today. They're basically non-existent, right? So if we're going through these Federal Reserve rates, they're hiking little bit by little bit by little bit, and look at the damage it's doing to the valuations in the stock market. In order to beat inflation today, if our rates are right now at about 2 to 3%, not even, in order to fight inflation, your interest rates need to be at least at the rate of inflation or higher. Our interest rates are very low. In fact, they're negative. The real inflation rate right now is probably at a -4 to 6 in the United States. In order to combat inflation, you would have to raise those rates to at least 8 to 10%. The Federal Reserve is talking about raising rates 0.5 to 3/4 of a point, and look at the damage it's doing to people's investments. And it's not just stocks, it's bonds, it's housing, the whole thing, right? So what has been done is they created this massive bubble and they went, oh crap, we have to pop it. And the bad news for people, if they're not prepared, is there is no escape from this. There is no safe haven. Cash is not a safe haven. I just demonstrated it. It's worth less and less every day. And bonds, which is very, very important for retirees, as a safe haven in their portfolio, bonds are not a safe haven. Even if you have a bond that's earning 2%, inflation's 8 to 10, you're still losing 6 to 8%. So you know those financial planning illustrations that are so cute on Vanguard.com and Fidelity.com? You know, their bond allocations are assuming which is typically 40% allocation in 40% of people's portfolio. It's assuming a 5% year-over-year return for 40 years, when actually that number is -4. So do the math. Over 40 years, if your financial planning illustration for 40% of your portfolio is 9% off, think of the damage that number creates. That makes sense?
Yeah.
So we have this is why this is all becoming a problem. Commodities. Look at the commodities right now. And this is in 2017. There's been a little bit of a bump here, but commodities are at historical lows. All of this is changing. Stock market, right? Remember what I said before about the stock market? Right?
Yeah, it's pumped.
2017, it's going up, up, up. Look, the rate of return since 2017 is 142%. And we just discussed over that time period, the average growth is 2% a year in the stock market or in actual production. That's how overinflated everything has become. And the problem is everyone's gotten a taste of these massive returns and these massive valuations in their house, in their cars, in their investment portfolios, in their bank accounts. And now all of a sudden it's getting popped, right? So you get used to, for example, if you're a person that normally eats, I don't know, you have a family, 3 kids, you know, you're going to your typical family restaurant around the corner, maybe a nice mom and pop shop. And then all of a sudden you just get these massive cycles and this massive valuation bubble that's created. And you've gone from eating at, let's say, Applebee's to now you're eating at, I don't know, what's a good steakhouse? Like a Morton's.
Morton's, yeah, that's the one I think of.
Right, mom and dad are no longer doing their Friday date night at Applebee's. They're now going to Morton's Steakhouse and having a martini and a ribeye. All of a sudden, you're coming in and telling people, "Hey, we have to pop this thing." So guess what? Your Friday night's going back to Applebee's and the $12 pick 3 appetizer that you were used to. So we're in this interesting dichotomy of we've had this massive bubble that the central planners have created, and now they're popping it. And I think one of the mental issues and psychological issues for people is going to become is it's been a free ride for 15 years. And now you're saying, hey, the ball game's over. Right. And it was like someone said before, it's like all of a sudden, they went shopping at a boutique store for all of their clothes and people are going to have to go back to Walmart. This is the other big problem. And this is why where we are today is a lot different than where we were before in the United States from a macroeconomic point of view. Like if you watch financial news, you'll hear, oh, back in the 70s and 80s, we fought inflation. Volcker came in and he raised rates and he fixed everything. The issue is Volcker, and the one thing Volcker didn't have to deal with is the US did not participate or have quantitative easing at the time, which is money printing, didn't exist. The second thing that didn't exist at the time is the massive debt to GDP ratio that the United States had, right? I think at the time, the debt to GDP ratio was maybe 30 or 40%. Don't quote me on that. You'd have to go back and look at it. But today, the debt to production ratio in the United States is 140%. Right? So that means for every dollar you earn, so if I make $100,000 a year, like the United States government's making $100,000 a year in income, but they're spending $140,000 a year. Doesn't seem like it's a program that's fiscally responsible. And that ties to the interest rate raise, because there's only so much that they can raise rates by, because if the Federal Reserve Bank continues their rate hikes for too much longer, they're going to bankrupt the United States government. That's the situation that we're dealing with today. And here's our buddy Jerome Powell. Is the Fed your friend? Who knows? But at this time, like we just covered, from 2008 to 2020, and even into 2022, it was, hey, it's a finance economy, injecting capital left and right, excessive valuations, and now they've created a bubble that they're trying to figure out how they're trying to shrink the bubble and not do it in a catastrophic way. But I would say, all in all, our point for everyone is, and this is the talk that's happening in all the, I would say, it's starting to hit mainstream media, but if you really hear the behind the scenes with investment professionals and the people that we're with every day, for us that are seeing it on a day-to-day basis, inflation is not going anywhere. We'll talk about oil and gas very, very shortly. But, I read 2 years ago, they were paying the equivalent of $50 for a watermelon in Japan. And I wouldn't be surprised if you saw that price here in the United States in the next year or two. And inflation and the rising cost of goods is becoming a serious, serious issue. And everyone's feeling it. So we'll talk about how we're gonna start to work through all this stuff. So this presentation and this part of the presentation, we're gonna make we're gonna make it applicable to the next 3 to 6 months and what we expect to see. So I would say, for anyone listening, if you're out there and you haven't really taken a look at your investments, your 401k, your retirement accounts, things like that, you have to look at them like literally today. Whether you do it yourself, call someone, call us, have someone review it. But if you're sitting with a traditional stock, bond, cash allocation, I think, and we think what's going to happen in the next 3 to 6 to 9 months could be potentially catastrophic to people's portfolios. One thing I did read last night, and it's chatter amongst a lot of the traders. And so this Friday, I think, is the 16th, right?
Yeah.
Friday the 16th. So with what I was reading, there is a massive margin call that's going to happen this Friday. I don't know if this is true or not. I don't know if it's going to happen. If it doesn't happen, just know we're this close to having a complete market shutdown. Anyways, here's Wall Street in 1900. Booming. We have cigars. It's great. Tons of people, right? Let's take a look at Wall Street circa 1985. We all know this from the movie Trading Places. This is on the floor of the stock exchange. What do you notice in these two pictures?
Just, it's different. There's a lot more yelling going on here.
Right. I'll go back to the last one. There's people, right?
Right.
People. You want to see what the stock market exchange or stock exchange looks like today?
No one.
No people anymore. And what does that mean? Everything's being traded by computer, and there are no quality controls and human controls behind it. This is a big deal. In the age of information, I think there's a belief that with more information comes less volatility, and that's actually opposite. With more access to information and more transparency, that creates more volatility, and with the way that Wall Street's set up between computer-based model trading, momentum trading, leverage trading, you now will see greater swings in anything that's market related going forward. That's just the reality of the situation. So this is kind of fun. Fund managers outperforming the market over the last 15 years. In 1982, 32% of portfolio managers would outperform the market. Right? Interesting. 2017, only 8%. Why is that? Well, we just talked about it. We're not in a capitalist economy. We're not in a free market economy. We're in a financed economy and passive investing, right?
Right.
You're familiar with Vanguard, right?
Yeah.
Right. Who was the founder of Vanguard? Do you know his name?
I do not.
His name was John Bogle. He ended up pulling all of his money out of Vanguard years before he passed away. He gave everyone the warning, and a strict warning in the financial industry. He said, if we go passive, it will be catastrophic and chaotic to the markets. That's where we are now, right? So you can see that before active management, because you could make quality investments based on fundamentals and performance and all that stuff, you know, the days of being able to outperform the market year over year has become much more difficult. On top of that, you now have the stock market ride, right? More volatility, broader investing, which we'll talk about, driven by computers, wider highs and lows. And like we talked about, there's not going to be less volatile markets. They're going to be more volatile just because of the access to information and transparency. The reason why this is important is think about the way that people have been taught to save, invest, and retire. If you look at someone's 401k right now, and if they were to retire today, they're not going to fund their retirement for the rest of their lives. Too many highs and now too many lows, right? So as an investor and as a planner, you have to really start thinking about how to get out of playing the market game, because it truly is a casino. On top of that, you have to be aware of your financial news. I always love this quote. Good book, Random Walk Down Wall Street, for anyone that's interested in a good book. I like this quote: stupidity well packaged can sound like wisdom. Jim Cramer is probably first and foremost on the list. The poor guy gets picked on so much, even on Twitter. But he was a successful fund manager, man. He did a great job. He built himself off the streets and came from nowhere. So you got to give the guy a lot of credit. But at the same time, if you were to look at his trades and you bet against, if you did the opposite of what he did, you would be doing very, very well. On top of that, we take a look at the average investor's returns. This is just important because we live in a do-it-yourself mentality. Hey, I can do these investments myself, especially with Reddit.com, Wall Street Bets, a lot of this other stuff. At the end of the day, if you look over a 20-year period of time, and this study's from BlackRock, the average investor basically earned 2.11% versus every other asset class category. So people are at the bottom of the list, and they're just outperforming cash, if you will. So that's where I think it's fine to do it yourself, but I don't think it hurts to have a professional in your back pocket to help you along the way, right?
Right.
All right. Building the portfolio. This is fun. Putting it all together. All right, so let's talk about some of the issues that we face today: technology, information, and regulatory oversight or lack thereof, depending on which side of the fence you fall on. In 1982, in the financial world, these are the issues we face: technology, information, and regulatory oversight. Sounds kind of familiar, right?
It's exactly like it shows here. It's exactly the same.
It's exactly the same. It's same fundamental problems. It's just different times. And it's just one of the things that I've been talking with people and I'm trying to promote is we need financial reform in our system, right? You know, and this is as a CFP, a CDFA, as someone that has, you know, my FINRA licenses and insurance licenses and all that stuff. You know, when you look at the major laws that govern the financial markets today, you had the Securities Act of 1933, the Securities Act of 1934. And Alex, this is good for you because this is for your Series 7. You had the Investment Advisory Act of 1940. And the last major, and after that was 1974, which was ERISA, which was basically, you know, governance for fiduciary retirement plans and retirement accounts. So that was big. IRA accounts, 401ks, pensions. In 2008, there was the Pension Protection Act, which was the complete opposite of its title. It put a nail in the coffin and just, you know, put pensions out of business. But we, you know, we're dealing with a world that's been governed and built off of rules and regulations that were developed over 80 years ago, almost 80 years ago, over 80 years ago now. We're almost going on 90 years ago, right? 90, yeah, 90. So, I mean, at some point, you would think this needs to be changed and updated. And it goes for the way we can do business. It goes for the way we can meet our requirements, because obviously we're fiduciaries and we want to do well by people. And fundamentally, no one argues with knowing your client because it's a protection for everybody. But, you know, it's just gotten to the point where it's getting to the point where it's detrimental to people and investors and financial professionals. The problem with our advice today, because it's built off of this archaic model, is the asset allocation, right? So I hinted on this before. Dollar cost average, go into stocks, bonds, cash. Most people have 60% in equities, 40% in fixed income and cash, so bonds and cash. That model's dead. Unfortunately, for most people and some of the professionals they're meeting with, they're going to die by the sword with this one. You know, I'm not going to call it the Titanic, but if some things happen which are lining up, it's going to be very, very painful for people, because whether it's cash, stocks, or bonds, there is nowhere to run and nowhere to hide. There's no escaping quantitative tightening. If you were to Google seminar, I got to think the conference, but Jamie Dimon, who's the head of JP Morgan, was at a conference back in July, and he just talked about it. He said, you know, never in the history have we dealt with quantitative easing, and we've never seen quantitative tightening, so we just don't know, right? And when you have the head of one of the top financial firms in the world saying, I think that's a message for all of us to be on high alert and make sure we're making some changes and getting defensive. The other thing is diversification. When we talk about diversification with people, everyone's like stocks, bonds, cash, and then they got emerging markets, large cap value, large cap growth, yada, yada, yada. At the end of the day, I think it's invest your money in the future. Make sure you diversify in a way which is smart, but watch for over diversification, right? And we did a lot of this work when I was at BlackRock, because we would run someone's portfolio through our risk management system, and they would come in and say, yeah, I'm 60% equities, 40% fixed income and cash, and I'm protected. And we would run analysis and say, actually, the correlation between your entire holdings is 90% equities and 10% cash. So you're really massively aggressive when you think you're moderate. That's the problem here, right? So people really need to start looking at their investments and looking at their portfolios and saying, hey, really, what exposures do we have, especially to the equities and to the bond markets? And how do we start to take some of that money and get it out of there and do something else with it? And this is an example of what we're talking about. So a lot of these different categories, and people can hit pause on the channel and take a look at this. This is how we think of asset allocation. And we think of, right, like we think of where should the money be that's going to do very, very well. And for us, and the way I think about things, it's like, I don't care what the market's doing. I just always want to be earning, right? No matter what it's doing. And there are so many different, as you can see, there's so many different opportunities to have other asset classes and investments that aren't brought to you from Fidelity, aren't brought to you from Vanguard. They're not taught to you in school. You know, that is potential exposures to where, you know, people understand and want their money, like income real estate and alternative investments. Alex, you know what an apartment building is, right? I think you're on mute, by the way.
Oh, yeah, sorry, there was a loud trucks passing by.
Oh,
Yeah,
right.
yeah.
All right, you know what an apartment building is. So if someone came and said, hey, we have an investment and it's a pool of, you know, however X many tens of millions of dollars that have been raised, and it all goes in direct apartment buildings that we can drive you to and show you, people understand that. So our biggest thing is we're trying to help people understand, like, you have to understand risk is not risk exposure to markets, but it's risk exposure to the bubble that's been created for the past 15 years. And how do you dial back that risk as they pop this bubble? On top of that, we take a look when we talk about risk with people, we think about it this way. It's now, how do you manage your risk, right? Can I self-insure? Can I say it's unlikely to happen, so don't worry about it? How can I reduce my risk through insurance? Or is it something that if it happens, I'll self-insure and pay for the losses, right? So when we look and sit down with people, and this is how people should really be looking at their entire financial model, which is your entire life. It's your house, your job, your car, like all of it, your insurance. Like, how are you managing your risk strategy and making sure you're mitigating as much risk as possible? Make sense?
Right. Yeah, it makes a lot of sense.
And that's where we kind of dive into the digital asset space. Disruptive ideas disrupt the world. So maybe blockchain technology. So for anyone who is listening in and is unfamiliar with blockchain technology, it's just, think of it as a big Excel spreadsheet in the cloud, right? That's probably the easiest way that I can explain it. And it records transactions for a business network. It can be utilized for web. It can be utilized for business. It can be utilized for consulting. IBM, Amazon, other large financial companies have all converted their infrastructures to the blockchain, I would say at least 10 years ago, right? I started seeing this pop up at conferences I was at, and it was like I would be at a financial conference, and then all of a sudden there was, I would look over and I'm like, hey, what's that over there? And it was this very, very interesting cloud technology. And then it was the blockchain. And so I dropped in on one. I went, huh. And then you started to do more research. You're like, IBM's doing it, Amazon's doing it, right? I mean, think about the amount of business that Amazon has to account for, buying, selling, transactions, the whole thing. The blockchain technology basically allows companies to handle a massive, massive amount of data and do it at the speed of light. I think that's the important thing. It's not only massive, it's not only transparent, but it is fast. And it's worlds faster than anything we've ever seen before. And if anyone Googles, let's use Bitcoin as an example, Google Bitcoin Lightning Network, right? So Alex, I'm here up in New England, and let's say you're, I don't know, pick a spot across the world that you like to go to or want to go to.
Oh, Japan.
All right, let's say you're in Tokyo. If I was to send you money to Tokyo from New England today, how long would it take?
Very long time.
At least 3 to 5 business days, right?
Right.
If I sent you Bitcoin right now on the Lightning Network, how long will it take for you to get it?
Hour tops.
Not even, it's already in your pocket.
Well, it depends on the system you're using.
Right. There's an hour for the validation of the transaction, depending on size for sure. Because you're always, and the exchanges are always doing their homework on that. But think about that. I went to, Europe when my oldest studied abroad, and the currency exchange from US dollars to euros was quite frankly laughable. It was a joke.
Oh, it is.
On top of the fact that I paid a 4% transaction fee on both sides. And I was just rolled over laughing in Rome. I'm like, I can't believe how archaic this is. So for anyone who's not familiar with blockchain and the technology, start to do your research, because it is going to change the world. It already is changing the world, but more importantly, not is only going to change the world, but it's going to change sectors. It'll change healthcare. It'll change real estate, which we'll talk about. It's going to change currency. It's already changed finance. It's already changed delivery solutions and retail, and it's coming to a door near you. Not a bad pitch. All right, so let's dump into digital assets and talk about these a little bit. Digital currencies and decentralized finance. We'll talk about digital art and also digital real estate. And the real estate thing is very, very interesting. And I can share some stuff that I've seen there and learned. So let's talk about why does old finance hate digital assets? So the crux of Bitcoin and decentralized finance is central planners cannot dictate what you do with your money. On top of that, with their earnings and rewards program, which is, in my mind, based off the concept of security lending in the traditional finance world, where if I own a stock, I can let someone borrow it for a fee, and then I get my stock back, and then I get the cash from the fees. You could do the same thing in the digital assets in the crypto space. So the point of that is, it really, really puts a big dent in the banking system, right? If you can take your money, lend it to someone, and it's no different than going to the bank, by the way. Essentially, when you put money in a bank, you're lending it to them. But the issue with most people is they're accepting the fact that they're not getting anything in return for the bank having their money, right? And the bank's lending it out and making 10, 15, 20% on credit and all that stuff. So we should be demanding more from the banks if they want our money. So this is a big reason why traditional finance hates the concept of digital assets and decentralized finance, because it takes away their power, it takes away their control. It takes away from the central planning. But as we're all seeing and about to experience, potentially in a very, very harsh way, central planning is probably not the saving grace. And we're just look at what's going on in Europe and the energy crisis and what's happening in Germany and Ukraine and Russia and all of it, right? People are starting to get fed up with it. On top of that, we talk about the demographics. Boomers, baby boomers. One of my favorite things on baby boomers I ever seen was George Carlin's stand-up when he talks about baby boomers. So we've been indoctrinated even in finance and financial planning. Oh, the baby boomers are coming. The baby boomers are coming. That's fine. But we're at the point where now the younger generations outnumber the baby boomers, right? So now we have a whole new world of new technology, new ways of thinking about things, new ways of things being done that are going to start happening in our day-to-day lives. And I just look at the range and the difference between my oldest to my youngest children. And I look at my younger children, I'm like, they know what a physical dollar is, but there's no value for them in it. And I mean, every child, so many children now that you go to school and they're getting computers. So the next generation, I mean, their entire lives are going to be in the computer-based world and on Web3 and all that stuff. So I just see this as a transition. We're transitioning to younger generations, to new solutions. We're going to see probably a lot of reform across the board in a lot of different ways. And this is why we're trying to help people when we talk about investing in the future and preparing for it. Like, the old way of doing things is over. It's not going to work anymore. Like 2020 through 2030 is a big inflection point, and it's a decade of transition. So as you can see, the demographics growing and the younger population's growing, it behooves everyone to adjust for that. Diving into digital currencies and what they are, I mean, people can read up on them. Software, it gives you ownership in the internet, like Bitcoin does, for example. It's kind of funny when you think about tangible assets, right? Because most people are used to, well, if I can hold it and feel it, then it must be real.
Right.
And I don't know that that's the case anymore, because you literally can own a piece of the internet. Right?
Yeah. I mean, times are changing. This is the biggest change that's happened in terms of technology and probably ever.
Right. And so if you look at it and what's happened over the past, I would say 18 months, especially with digital currencies, if you notice on all the major financial news in the US, Bloomberg, was it MSNBC, Fox Business, all the tickers that come across your screen, Bitcoin, Ethereum, Litecoin, they're all listed. Back in 2021, I think it was. I don't think it happened earlier this year, it was last year. Within the past year, Morningstar added digital assets as an asset class. So it is similar to an emerging market. And now it has a place in people's portfolio now. And like I said, the stuff isn't investment advice, but you have to consider it. Why Bitcoin? If people haven't done their homework on Bitcoin, they should probably do it. We would probably compare Bitcoin to digital gold. I think that's really where Bitcoin sits, where the sweet spot is.
That's how I always describe it as when I'm talking about it.
Right. It's digital gold. Like, Bitcoin's your digital gold. And the other thing is, what people understand is, there's a lot of FUD, right? Fear, uncertainty, doubt, bad news. Oh, it's bad for the environment. Well, these miners and the people mining Bitcoin from an energy perspective are light years beyond anyone else. The things that they're doing are fantastic, and they're using hydro, wind, solar, even nuclear. And I come from a family, I grew up in the energy business. I come from an energy family. And, this electric vehicle thing is just nonsense. It's one of the worst, most inefficient energies possible. But, go dig to the core of the earth to get the minerals for it, because that's a good idea. And then on top of that, you just look at it, it's more about innovation. And if you look at the number one source of used energy, and if you really want to start, I would say, conserving energy and being more environmentally friendly, then you're going to have to shut down your banks, because they consume more energy than anyone in the world. Decentralized finance is open protocols, very limited to no human intervention, transparency. That's really what the blockchain is about. Ethereum is probably the number one most popular in this category if you were going to do some research about this. And then there's other different protocols that are out there that are very, very popular, like Solana, any Cardano, Litecoin. It just, these are all things that I think people should become aware of and start to study more. We're not going to go into detail about that. We could probably we'll do that in another segment. But if you're curious or dabbling or want to get into this space and learn more, start, I would say, learning Bitcoin and start doing your homework on decentralized finance. Stablecoins, the theory behind them is they operate similar to a money market fund, which is backed by a reserve asset like the US dollar, the yuan, gold, something like that. These can be used as a supplement for some of that 40% portfolio to help generate yield. In the United States, there's still a lot of back and forth on, how to regulate these, what to do with them, how are they offered to the general public, and how are they made widely available. So we expect to see more on that. So we're not going to talk in great detail about these things, but just another segment of the asset class that I think it helps to do your homework on. On top of that, we're just going to share something quickly on our conference findings from our Bitcoin 2022 conference. So if you think about Mr. Wonderful, right?
Yeah.
We all know who Mr. Wonderful is, right? From Shark Tank, right? It was kind of funny because he just got off his private plane in Dubai, and he was he was calling in from halfway across the world. Here's basically what most of your, I would say, innovators and business people at the very, very top are saying. If the United States does not step into the digital asset space, we're done. We're going to be so far behind the curve in terms of innovation. And you're already seeing countries and sectors, or not sectors, but segments of the world that are really starting to adopt this. If you pay attention to what's happening in the Middle East and Dubai, especially, Dubai is setting up to become the financial capital of the world. And they are on the forefront of digital assets. They are on the forefront of the investment management, and we're just, in the United States, I don't even know what we're doing anymore. We're just falling behind day over day, day over day, day over day.
Really unfortunate.
Yeah. And the other thing too is big firms are getting in. Fidelity just announced this week they are going to offer Bitcoin to their 34 million clients. BlackRock took a big stake in Coinbase about a month ago, and they are going to bring it to their institutional investors. If anyone out there does not know BlackRock, they manage over $10 trillion and probably influence anywhere from $40 to $50 trillion across the world. So they're a firm where I would say this is the archaic part of the system again, is companies like BlackRock are so big, they're above the nation state game, right? Like the game of nation states is so 1900. And with the way that a lot of these large organizations are set up, not just here, but in other countries across the world, it's just, we're so far behind, and there's so much that we need to do across the board to catch up. But the point is, digital assets are being adopted, and there's a lot of work going to them. Digital art and NFTs. This is a very interesting topic. So let's say you have your Michael Jordan rookie card that you got. What year did he come in the league? 81, 82?
Not a basketball guy, so I don't know.
Yeah. I should ask you a hockey question.
Not even that knowledgeable about that.
Right. Now Jordan's like, you played basketball? What's your problem? You don't know when I came to the league. Sorry. I apologize, Michael. Think of it this way. If I have a Michael Jordan rookie card and it's sitting in my drawer and it's cool, and one day, maybe even after I die, my kids get it or family gets it and they decide to sell it, that's cool. Digital art is pretty similar, except it's, as it says, digital. So I can have an authenticated Michael Jordan rookie card on the blockchain, which is essentially mine because I hold the personal key to it, which makes it valid and means it's not a knockoff. It's not fake. And then from there, I can decide to do whatever with it. I can sell it. I can keep it. It's pretty much my option. I think the interesting thing for digital art is for, I think, gamers, musicians, the creative industries, artists, like digital art is a great way to promote what you're doing and what you're developing. And if you're an artist like a Picasso, instead of painting, he did the Mona Lisa, right? Yeah. Instead of
didn't do the Mona Lisa.
Oh yeah, yeah. But anyways, whatever, I'm not huge into art, obviously, but if I had one Mona Lisa and instead of having one, I created 100 and sold 100 authentic Mona Lisas, that's a good way to expand my footprint and expand my business. So digital art is really interesting. I think it ties in well to digital real estate. My youngest daughter she likes to design houses in the digital world. And no joke, they literally buy art for their digital living rooms. So just saying, it's an interesting world.
Yeah. We were both wrong. It's actually Leonardo da Vinci who.
Right. It was da Vinci, not
even.
I was drawing a blank on that one.
Starry Nights, which is Van Gogh, but
yeah, I apologize to all the artists out there. I'm only so with art, but much better with music. Real estate. Yeah. Real estate's very, very interesting. So not only can you buy real estate, it's just now it's become a digital asset as well. You can have a domain, you can own a part of a website, intellectual property, games, different products. And I mean, a lot of the celebrities are starting to get into this space, right?
Right.
I'm going to check the next slide quickly, because this ties into real estate. And Adapt or Die, this is one of my favorites. I'm a huge Moneyball guy. That's one of my favorite movies. Here's the thing with digital real estate. I learned first through an introduction that I met at the Bitcoin conference, but I came across companies that are going to take real estate to a whole new level and put it on the blockchain. So think of Zillow, except I would say on steroids. So if you're in the real estate game right now, traditionally you would hire a broker, find your property, get a real estate agent, or you have your real estate agent, but get your real estate attorney, go through your traditional lending, do all of your filings and titling, and you have that whole process to purchase commercial, residential, what have you, right? That is all within the next 5 to 7 years going to be completely gone. And I spoke about this in a presentation I did with a real estate office, or at a seminar I was asked to speak at in Atlanta a couple months ago. And I said, listen, what if I told you that every single one of you and the professionals will be out of this business in 5 years? And then I walked them through it. And, people, if you Google that Paul Berzik article right there, it tells you why and how. So basically every property across the world in real estate will be listed on the blockchain, available for anyone in the world to find. It will be a direct peer-to-peer transaction. So if you're, if you're in Tokyo and I'm in the United States, over in New England here, Alex, and I said, hey, I like your house, I want to buy it from you. We write up our agreement on a smart contract, which is published transparently on the blockchain. Mm-hmm. I pay you in digital assets or cryptocurrency, or we come up with a lending agreement in which I could stake my coins and you get the interest from my coins, and that pays you per the term of our agreement. So I just eliminated your bank because I don't need your bank anymore, and we don't need a bank anymore. Our title is now held as a smart contract on the blockchain, so now we don't have to worry about filings. And because we don't need a real estate agent, because we have our own smart contract, we don't have the need for an attorney.
Right.
So every single professional in the current real estate process through innovation can be eliminated. So remember when we were talking about risk before, managing risk, job risk, industry risk, sector risk. We're in a massive transition. This is what we're trying to help people understand. It's if the ship's going down, or if it's going in another direction, you have to get on the lifeboat, or you have to change direction. So I think the blockchain, the digital asset space, the entire thing, it's innovative, it's disruptive. It's almost like we had the internet in 2000 and everyone's like, oh, what the heck is this thing? And now everyone's on the internet all the time. This is the next wave of it. So kind of wrap these things up. Like we said before, and what we talk about with people is, it's not a crash per se. It's a crash in the traditional way of thinking and approaching things, for sure, I think. But it's a transition and a transformation to what is new and what is ahead. Traditional financial planning and finance and planning is no longer working. It's just, and you can see it, right? It's just sad to see right now. Like we get calls into trying to help people who are older, and the saving to retirement, having a 401k or relying on a 401k IRA account and hoping you get enough from the government to fund and cover your medical costs. That game's over. There's a lot of talking about retiring with dignity, which I think is a horrific line in our world. If you look at what people are dealing with in retirement, I got a call from, a friend of mine who had two parents go into a nursing facility and they're 90, 92, and the facility, because they need full care, it's $15,000 a month.
Mm-hmm.
He gets a pension for $2,500 and Social Security for $3,000, and they don't have any retirement savings. They have some, but not to cover, $10,000 a month for any significant period of time. And they're already at the end of the spend down. So we just sit and talk with people like, listen, if you're playing this 401k game and you don't believe me, just go listen to what Robert Kiyosaki says, Rich Dad, Poor Dad. He'll tell you straight from the horse's mouth, man. That whole saving for retirement, saving till you're working till you're 70, 72, if you're lucky, based on your health and the fact that you're not going to get run out of your job or innovated out, and then hoping you have enough to cover expenses, that game doesn't work. It's already failed, and we only got to the beginning of it. But with that said, you have to take a look at where the world is moving towards. And if you position yourself properly, you won't be worrying about any of those conversations, right? So manage your risk, rethink the way you invest, rethink the way you talk and think about retirement, and really start to hone in on, okay, how can I really position myself and my family and my businesses, if you're a business owner, in the right spots to where we're going to become extremely successful and have awesome investment opportunities and planning opportunities, which are making themselves available right now, right? Because at the end of the day, wealth is neither created nor destroyed, it's only transferred. So that's it for the presentation. If anyone has any questions, feel free to give me a call, shoot me an email, go to our website, twinshoreswm.com, twinshorescapital.us. We're just happy to help and hope that this presentation and information was informative and can help you make some wise decisions.
Yeah, just as to repeat and reiterate, Thank you everyone for listening. If you enjoyed it and want to keep up to date on everything that we do, please like, share, subscribe. Any questions or comments, either email, call, or just leave a comment down in the comment section below. Again, I'm Alexander Kaminer, and that's Tim Nihill.
Thank you, everyone.